Join TWR in 2023. TWR Tech Video. What is up, team? Chuck with Traders War Room, and I'm back at you with another video. This is your tech video for the weekend. And guys, just got to say, we got the Super Bowl today. And you know what? Go Chiefs. All right. You guys know my team. Hopefully they pull it out. But you know, it's going to be a tough game. Just like we battle the market, they're going to be battling on the gridiron, and to the victor goes the spoils of war. You know what I'm saying? But I got a fantastic video for you today. We're going to talk about high beta and low beta stocks. This has been a buzzword that has been going on in the marketplace for a while. So I want you guys to understand, when we hear these buzzwords coming on, it's time to start paying attention and learning about what these buzzwords mean, because it could get us some definite moves and be able to profit from some shakers and bakers based off of these buzzwords. Okay, so we're going to talk about these buzzwords. And real quick, I do have a Super Bowl special for all of you that are not Traders War Room members. Give me 30 seconds right here, right after this, and watch this, and then we'll get started into the video. Without further ado, hey, if you're ready, follow me, and let's go to war together, baby. Traders War Room, Super Bowl Sunday. Go Chiefs. Let's get it. TWR Tech Video. High beta versus low beta stocks. All right, so when we're talking about high beta versus low beta stocks, really, we're talking about how should investors assess risk in these stocks and determine whether they're buy or sells. While the concept of risk is hard to factor in stock analysis and valuation, one of the most popular indicators is a statistical measure called beta. Analysts use this often when they want to determine a stock's risk profile. However, while beta does say something about the price risk, it has limits for investors looking to determine fundamental risk factors. So let's now get into what beta is. Well, beta is a measure of the stock's volatility in relation to the overall market. By definition, the market, such as the S&P 500, has a beta of 1, and individual stocks are either ranked according to how much they deviate from the market. A stock that swings more than the overall market has a beta higher than 1. If a stock moves less than the market, the stock's beta is lower than 1. High beta stocks are supposed to be riskier but provide higher return potential, or ROI. Low beta stocks pose less risk but fewer returns. Continuing on, beta is a component of the capital asset pricing model, or the CAPM, which is used to calculate the cost of equity funding. The CAPM formula uses the total average market return and the beta value of the stock to determine the return of rate the shareholders might reasonably expect based on perceived investment risk. In this way, beta can impact a stock's expected rate of return and shared valuation. So calculating beta. It's calculated using regression analysis. Numerically, it represents the tendency for a security's return to respond to swings in the market. The formula for calculating beta is the covariance of the return of an asset with the return of the benchmark divided by the variance of the return of the benchmark over a certain period. To calculate the beta of a security, the covariance between the return of the security and the return of the market must be known, as well as the variance of the market return. Covariance measures how two stocks move together. A positive covariance means the stocks tend to move together when the prices go up or down. A negative covariance means the stocks move opposite of each other. Variance, on the other hand, refers to how far a stock moves relative to its mean. For example, variance is used in measuring the volatility of an individual stock's price over time. Covariance is used to measure the correlation in price moves of two different stocks. So again, the formula for calculating beta is the covariance of the return of an asset with the return of the benchmark, divided by the variance of the return of the benchmark over a certain period. We will talk more about that when we break out here in a little bit on individual stocks. But right now, we're going to go on and move into the advantage of beta. Followers of the CAPM, beta is useful. A stock's price variable is important to consider when assessing risk. If you think about risk as the possibility of a stock losing its value, beta has an appeal as a proxy for risk. Intuitively, it makes plenty of sense. Think of an early stage technology stock with a price that bounces up and down more than the market. Now, it's hard not to think that the stock will be riskier than, say, a safe haven utility industry stock with a low beta. Besides, beta offers a clear, quantifiable measure that is easy to work with. Sure, there are variations on beta depending on things such as the market index used and the time period measured, but broadly speaking, the notion of beta is fairly straightforward. It's a convenient measure that can be used to calculate the cost of equity used in a valuation method. Now, disadvantages of beta: if you're investing based on a stock's fundamental, beta has plenty of shortcomings. For starters, beta doesn't incorporate new information. Consider a utility company, and we'll call this company X, for example. Company X has been considered a defensive stock with a low beta. When it entered the merchant energy business and assumed more debt, X's historic beta no longer captured the substantial risks that the company took on. At the same time, many technology stocks are relatively new to the market and thus have insufficient price history to establish reliable beta. Another troubling factor is that the past price movement is a poor predictor of the future. Betas are merely rear view mirrors, reflecting very little of what lies ahead. Furthermore, the beta measured on a single stock tends to flip around over time, which makes it unreliable. Granted, for traders looking to buy and sell stocks within short periods, beta is fairly good risk matrix. However, for investors with long-term horizons, it's less useful. In layman's terms, it's a great thing for people who are looking to trade for profit in short term, right? It's less great for those that are looking to invest in a company over the long haul. Now, let's talk about assessing risk. The well-worn definition of risk is the possibility of suffering a loss. Of course, when investors consider risk, they are thinking about the chance that the stock they buy will decrease in value. The trouble is that beta, as a proxy for risk, doesn't distinguish between upside and downside price movements. For most investors, downside movements are a risk, while upside ones mean opportunity. Beta doesn't help investors tell the difference. For most investors, that doesn't make much sense. And there's an interesting quote from Warren Buffett, who I'm sure you guys all know, regarding the academic community and its attitude towards value investing. The quote goes like this: "Well, it may be all right in practice, but it will never work in theory." And that holds as true as when he made it as it does today. And here's a picture of the man. In case you want to learn more about him, you can just Google and find all sorts of information. But he is also known as the Oracle of Omaha. All right, so continuing on, we are talking about value investors that scorn the idea of beta because it implies that a stock that has fallen sharply in value is riskier than it was before it fell. A value investor would argue that a company represents a low-risk investment after it falls in value. Investors can get the same stock at a lower price despite the rise in the stock's beta following its decline. Beta says nothing about the price paid for the stock in relation to fundamental factors like changes in the company's leadership, new product discoveries, or future cash flow. Benjamin Graham, who is quoted as the father of value investing, and his modern advocates tried to spot well-run companies with a margin of safety, that is, an ability to withstand unpleasant surprises. Some elements of safety come from the balance sheet, like having low ratio to debt to total capital. Some come from consistency of growth in earnings or dividends. An important one comes from not overpaying. For example, stocks trading at lower multiples of their earnings are viewed as safer than stocks at higher multiples, although this is not always the case. Now, with all that information, let's go ahead and get into the beta examples like I told you we would do earlier in the presentation. Beta could be calculated by first dividing the security's standard deviation of returns by the benchmark's standard deviation of returns. The resulting value is multiplied by the correlation of the security's return and the benchmark's return. Remember, this is our formula when we're looking to calculate beta. So let's calculate beta for popular stock, right? Let's look at Apple. An investor is looking to calculate the beta of Apple as compared to the SPY. Based on recent 5-year data, the correlation between Apple and SPY is 0.83. Apple has a standard deviation of returns of 23.42%, and SPY has a standard deviation of returns of 32.21%. In this case, Apple would be considered less volatile than SPY as its beta is 0.6035, and this indicates the stock theoretically experiences 40% less volatility. Now let's talk about a riskier stock, right? Tesla, for example. Let's assume the investor also wants to calculate the beta for Tesla in comparison to the SPY. Based on the 5-year data ratio, Tesla and the SPY have a covariance of 0.032, and the variance of SPY is 0.015. Therefore, Tesla, in theory, is 113% more volatile than SPY. In conclusion, betas vary across companies and sectors. Many utility stocks, for example, have beta less than 1. Conversely, many high-tech stocks on the NASDAQ have a beta greater than 1, offering the possibility of higher ROI, but also posing more risk. It's important that investors distinguish between short-term risk, where beta and price volatility are useful, and long-term risk, where big-picture fundamental risk factors are more prevalent. Investors looking for low-risk investments might gravitate to low-beta stocks, meaning their prices won't fall as much as the overall market during downturns. However, those same stocks won't rise as much as the overall market during upswings. By calculating and comparing betas, investors can determine their optimal risk versus reward ratio for their portfolio. Ultimately, it's important for investors to make the distinction between those short-term risks where beta and price volatility are useful and long-term fundamental risks where the big picture factors are more telling. High betas may mean price volatility over the near term, but they don't always rule out long-term opportunities. Which is why one of the sayings I repeat over and over again when we talk about trading and investing: scared money doesn't make money. Up next, TWR products and services that can make you bank. Upcoming TWR classes. And our next TWR class is set, so register today, guys. The link is in the description, or you can always go to traderswarroom.com/upcoming classes. On 19 February, our guest instructor, Diesel Trades, is going to teach you how to day trade by reading candles, volume, and momentum. And if you guys have not seen Diesel trade, he is a fast-paced, big money-making machine, guys. He is badass. And for $25 for a 2-hour class, you can get your seat reserved. And oh, by the way, every purchase gets the recording for a tool. Guys, we want you to plan your battle with TWR classes and make that market bend the knee, because TWR bows to no one. I'll see you in class on 19 February at 1 p.m. Central Standard Time. And don't forget, the link is in the description or traderswarroom.com/upcoming classes. Traders War Room is your one-stop shop. try our TWR one-to-one mentoring. Does the market have you feeling like this, or wanting to rip your hair out while you watch your account dwindle? If that's you, then Traders War has you covered. Our one-to-ones focus on you as a trader or investor. The Zoom session connects you with a TWR professional. Whether we're covering charts, developing a plan of attack, or being strategic and deep diving on the how, why, and execution of trade plans. TWR one-to-ones will give you the confidence to attack, conquer, destroy, and make the market bend the knee in 2023. Join TWR and bow to no one. Book your session today. The link is in the description or on the website at traderswarroom.com. Let's go to war. TWR Trading University is happy to announce open registration for our next option fundamental course. Did Wall Street make you feel like a complete loser in 2022? Or was everything going great and you blinked just for a split second and got repeatedly kicked in the you-know-what over and over again? TWR is here to help you. Our university's fundamental course is an in-depth 5-week-long course that's done live via Zoom platform. Our virtual classroom is where you can interact with the instructor, other students, or see copies of the classes right there on the platform and rivals that of traditional online education. Testimonials from previous class graduates are proof that our cradle-to-the-grave approach works in giving you consistently profitable skills to trade options. Registration is open today. Links are in the description or go to traderswarroom.com. I will see you there. Let's go to war. Join the TWR Investment Club. Check out our free chat to learn more. That's it, team. Don't forget, make the market bend the knee in 2023. Join TWR and bow to no one. The link is in the description or on the website at traderswarroom.com. Let's go to war.